All right, so what are the 5 best ideas to optimize the Smith Maneuver? So Smith Maneuver, it's a quirky name for a strategy, but you know, it really works. It can make a big difference in your life. But let's say you already know the basics. You know kind of how it works, converts your mortgage to tax deductible over time. So let's talk about the practical issues in implementing it and now actually how to maximize the benefits. So all right, so my name is Ed Rempel. I'm Canada's Smith Maneuver experts. My team and I have actually helped thousands of families implement the Smith Maneuver, and we're experts in not just implementing it, but we're experts in implementing it, not just getting the mortgage. So my blog, Unconventional Wisdom, is the #1 blog in Canada for a financial planner, and I've got the best article and most comprehensive about the Smith Maneuver on the internet on my blog. Just go to Unconventional Wisdom. So, all right, so how do we make this, how do we optimize the Smith Maneuver? So the first thing is you need to do it for the right reason. So why are you going to do it? If you want to do it, why do you want to do it? So now a lot of people do it for the tax deduction, and you know what? That's the wrong reason. So of course there are tax deductions, but you should not do it just for the tax deduction. Overall, when you look at various versions of it, usually the tax benefits are only about 15 to 20% of the benefits of the Smith Maneuver over time. Most of it is the leveraged investing, because you're borrowing and investing that makes a higher rate of return over time. So, and it's a risky strategy that you want to do it right. So don't do it just for the tax deductions. The other thing is I've had people do it to, get rid of debt, which is, I always kind of find that kind of funny because you're borrowing to invest. So this is not a strategy to get rid of debt. Okay, it converts your debt to tax deductible over time, doesn't get rid of it. So now, why should we do Smith Maneuver then? The real reason is it helps you invest for your retirement without using your cash flow. That's the real reason. It should be part of your long-term financial plan. It can help you build that long-term security. And so it doesn't, since it doesn't use your cash flow, this is completely in addition to all of your normal savings, all your RSPs and TFSAs, investing in your corporation and everything else that you may do. So now I can tell you from experience, we've done thousands of financial plans, and retiring comfortably is actually difficult. You got to save much more than you think you need to. So, but the Smith Maneuver, very often when we do a financial plan, what we find is our clients want to retire comfortably, but they have to put away too much money to get there. So it really cut into their lifestyle today, and the Smith Maneuver often makes up that difference. Okay, so the Smith Maneuver should be part of your long-term retirement plan. Helps you live now the way you want, and also invest for your future. So here's an example of a typical retirement plan, or an example of how it looks with and without the Smith Maneuver. So let's take a couple of, they're 40 years old, they're married, they earn 150,000 together, like 75,000 each, and they want to retire on 100,000 in today's dollars. And let's say they're 40 and they want to retire at 60, so a little bit earlier in 20 years. So this is a fairly comfortable retirement. Then it's 20 years, not 30. So it takes a little work to get there. So let's assume in this one, they're going to invest 100% in equities. We've got 3% inflation built into this. And we're assuming they're getting the maximum from the government benefits, the Holy Security and the CPP. And for the Smith Maneuver part, we're assuming they have $1 million home, but they don't have all they just had the 20% down, so they've got an $800,000 mortgage, and they're just starting it. There's no extra equity to start off with. So let's take that example. So now, if this couple doesn't want to do the Smith Maneuver, the magic number in order to retire, they need to get by age 60 up to $2,370,000. To get there, they'd have to invest $50,000 a year. Okay, now we've assumed 100% equities, we've assumed 8% a year as the long-term return on their investments. So 50,000 a year they have to put in. Okay, so that's maxing their RSPs plus their TFSAs, maxing them plus 11,000 a year. So that's actually a lot. It's a third of their total income. It's going to be really hard for someone to put that much money into the retirement plan. Okay, so let's say the same couple just starts to do the Smith Maneuver now. Now what happens is they need $2,830,000. So they need more in retirement, because we need to also be able to pay the Smith Maneuver tax deductible interest after you retire. Okay, so now in this case, they need to invest 34,000 a year. So now 34,000 a year is actually just maxing their RSPs and not even maximizing their TFSAs. It's a little bit less than maximizing both. That's all they have to do, plus the Smith maneuver, and that makes up that difference. So it's only 23% of their income. So see, overall, 16,000 less a year they need to invest to have the same comfortable retirement. Just an example of how the Smith maneuver makes a difference in your retirement plan. So, and that's why you should really do Smith maneuver with a financial planner. So, and not, so someone, so that it's part of the plan, someone who knows how to make it work. So now the next thing is the mortgages. So this is the number 2 way to optimize it is get the right mortgage. Now you need a readvanceable mortgage, not a regular mortgage. So it's a mortgage linked with a credit line. So as your mortgage gets paid down, you automatically gain credit available in the credit line. Now, there are 9 readvanceable mortgages in Canada, and these are my ratings on them, how I rate them. So now most of them work fairly reasonably well, and they have quirks, and you can work around them. So for example, what we look at is, can you invest directly from the credit line? Or do you have to put money into a separate checking account and then move money over there? So it's more manual work. So does it readvance automatically? Or do you have to sign a paper, or do you have to wait till the end of the month or something like that? Some of them allow you multiple credit lines. And that's actually very useful because you can use it for other purposes. If you use part of your mortgage, your credit for buying a car or other expenses, renovations and things like that. So you want to keep your deductible and non-deductible separate. So do they allow multiple credit lines? So some of them also do allow multiple mortgages is another question. So once your Smith Manoeuvre credit line gets quite large, it's actually useful to convert it back into a mortgage. And now what you're getting is a lower interest rate than you would on the credit line portion. So it can be a plus to do it. Now there's more manual work. You can actually get it so the cash flow part works the same by, in essence, using your cash flow for interest only on the mortgage by capitalizing the principal portion. There's a method to do that. But the bottom line is you can have, if you have multiple mortgages, it's a very useful thing. Also, when your mortgage gets paid down to only 15% of the value, or then and your credit line is now up to 65% of the value, it's the maximum that you can do. So there's a point in this where you really have to have 2 mortgages, your small remaining non-deductible one, and then you put the Smith maneuver into a deductible mortgage. So the question is, do these all the readvanceables have a multiple mortgages or not? So another one is, do they invest from the first dollar, or do you have to wait until it grows a little bit to do that? Some of these have a monthly fee, and most of them don't, but some of them do. Also, do they have competitive rates? Some of these institutions are really always competitive, and some tend to not be. So now, interestingly, is when you look at them, they're all reasonably good. The one really bad one is this Manulife one. It's kind of a disaster. It's funny because I run into people who are experts, who claim to be experts in Smith maneuver, and they recommend people take this Manulife one, and it's a disaster. So all the other ones, you can borrow up to 80% of your home, and you can readvance from the first dollar at 80%. So but Manulife, you can only do 65%, so it's quite a bit less than it does. There's a monthly fee, and it's actually really awkward to work with. They usually don't have competitive rates, so that one is kind of a disaster. I would kind of warn you away from that one. It'd be lovely if it worked, but it really is kind of a pain. You can do it with a Manulife one, but it's just really a pain to do it. So I just find it strange that some people who claim to be experts recommend it. So this is again why you should do it you should do Smith maneuver with a financial planner, not just get the mortgage from a mortgage broker or a mortgage specialist or a bank mortgage person, because they get you the mortgage, but then after that, it's up to you to implement it and monitor it and all that kind of stuff. Okay, the third way to optimize the Smith maneuver is keep your credit line 100% tax deductible. So, and there are some, you got to make sure that you do that. So now there is a CRA, it's called Folio S3-F6-C-C1 on interest deductibility. You can look up on the internet. It's got all the actual rules on there. All right, so the first thing is the investments that you buy need to have an income potential. Okay, so that means they could potentially pay interest or dividends. They don't actually have to pay it. They just have to be capable. As in, so what that means is basically any stock, any company that you invest in should be tax deductible because it could pay a dividend. All right, so any stock market kind of investment is usually fine, but you can't use it for, raw land or gold bullion bars or options or crypto or something like that can't possibly pay income. All right, so that's the first thing. Now, a really important part of keeping it deductible is you have to keep your deductible and non-deductible debt separately. We had a client come to us a few years ago. They already had started Smith Maneuver, but they had a credit line and they'd used part of it to buy a car and part of it to invest with a Smith Maneuver. So now it's kind of a disaster. You have to track how much all it is. And technically there is a way to deal with it by tracking every single dollar, but it's a real pain to do that, and it's a problem if you if you're ever audited and have to try to prove all that stuff. Usually the best thing, and once it's mixed, is just sell everything, pay it all off, start over from scratch, maybe create a separate credit line. That's why you need a readvanceable mortgage that allows multiple, and then split them at that point. It can be quite a disaster. So now another one is you need to keep your interest capitalization right. Okay, you have to do it right. So interest capitalization is the part. It's why the Smith Maneuver, the whole strategy, normally does not require any of your cash flow to do it. That's right. It's all entirely self-funding, and the reason is you borrowed some money to invest, but you can borrow from the credit line. The credit line you can borrow from it to pay its own interest. Okay, so it all stays deductible that way. But now there's two kind of main methods. With some banks, you can actually invest directly from the credit line. In that case, the investment part happens there. The only part that has to be capitalized is the interest on the credit line. And that can come out of your checking. You go back to the credit line and you transfer back to your checking the exact amount to the penny, make it to the penny, so it's clear that that amount you took out of the credit line and put into your personal checking was to pay the interest. Okay, and that keeps the tax deductible. The other method to do it is you create a separate Smith Maneuver checking account and use it only for Smith Maneuver. In this case, you can have the investment come out of there. Also, if you've got multiple mortgage and tax deductible that are all part of the Smith Maneuver, they're all tax deductible or an investment loan, and monthly investments going out, they can all come from this one checking account. In that case, you transfer from your credit line into that checking account, and it doesn't have to be the exact amount. It's just you have to make it enough so that nothing bounces, that it covers all the payments. So usually all you do is just take all the available credit and just put it in the checking account each month. So that's kind of the other method with the separate checking. So now Smith Maneuver is, it's not really that hard to do, but it's actually not that it's fairly easy to mess it up. And if you ever get audited, here's what, because we've had every year we get a couple of clients that get audited or something, and we deal with it. So for our clients, when we implement the Smith Maneuver, we choose, if we do your tax return, that you contact us. CRA contacts us if they have any questions, and then we represent you. We know how to do that, how to deal with it. But here's the issue: is CRA doesn't look at your numbers and say, okay, well, here's what the correct number is. What CRA does is they just say, here, prove to your number that your deduction is correct. If you can't prove it, we just deny the whole thing. So then it's entirely up to you to prove the entire number. Okay, so that's why you need to have the right figures and to be able to track all this. And that's why it is useful to be able to do, when you do Smith Maneuver, have a CPA or a tax accountant that you're working with that can do all this for you and can represent you with CRA if you need to. All right, the fourth item on optimizing the Smith Maneuver is doing the right strategy. Okay, and now, a lot of times you may think Smith Maneuver, or just you're doing it, or it's just one way to do it, but actually there's lots of ways to do it. So there are now 8 different Smith Maneuver strategies, and depending on your situation, they have different amounts of different benefits and different amounts of benefit and different ways of doing it. So let me just go through them and make sure you can see which one actually suits you the best. So first one's called the Plain Jane. It's just a standard one. Okay, Plain Jane means you don't start with any lump sum. It's the one that's in the original Smith Maneuver book, and you're just investing. You start with 0, and you're investing every month or every 2 weeks directly from your investment credit line. and you building up converting the mortgage over time. That's the plain Jane. Now the debt swap, often before you start, if you have some you have some room available in your credit line, you have some debt that's not deductible, you can sell investments, pay off your credit line, your non-deductible, and then re-borrow to invest. So once you have some available, so that's called the debt swap, and it's you kind of instantly convert some of your existing debt into tax deductible. Also called singleton shuffle. That's based on a court case with people named Singleton. Fraser Smith used to call it the Flintstone flip, a so creative name. But so that's often something that you do, in the process of setting up. You convert your debt to tax deductible as part of the plan, and then implement Smith Manoeuvre. Third one is the top up. That's just if you get your mortgage and you've got available credit line. If you have $1 million home, and let's say your mortgage is only $500,000, you can get a limit up to $800,000, which means you're starting with a lump sum of $300,000. So you invest $300,000 right off the bat. Remember, it doesn't cost anything for your cash flow, and then on top of that, you're investing a bit every month. So that's called the top up, because you're topping up your credit up to the limit. A fourth method is called the triple top up, and what that is, you just take this is a pretty aggressive method, but you just take the top up amount and you go get a 3-for-1 investment from it. So if you have $300,000 available, you can go get a $900,000 investment loan. See, it's a big aggressive strategy, then you'd have to maybe increase your mortgage payment. You have to make sure you pay enough principal to be able to pay all of this, but that's kind of a fourth, more aggressive it's a way to build your net worth quite a lot faster method. Another one is called the debt miracle. This one's actually really interesting because we had clients years ago, and what happened is they had a bunch of different debts. So they had their mortgage, and they had quite a bit of credit available. Like they paid their mortgage down quite a bit. They've been focusing on that. But on top of that, they had a car loan, they had credit lines, they had some credit cards, they had a student loan or RSP loan, they had all these other debts. So what we did is we refinanced the mortgage, paid the penalty, get out of the mortgage, increased the mortgage to pay off absolutely everything. Then we took the total payment that they were making from everything. They were paying like over $3,000 a month for all these different payments. And we made that their new mortgage payment. And now what happened is, so before this, they were just totally debt strapped and they were just struggling to make all these payments. They were not able to save anything for retirement. Now what happened is we'd put all of their debt at the lowest possible rate, and they have a big mortgage. They're paying off the mortgage in 10 years or so. It was pretty fast. And now they were investing about $2,500 a month in the Smith Manoeuvre, like quite a large amount. So it took them from a desperate situation to advancing and building wealth really fast. So that's why in the right situation, it can be just a complete miracle to set it up this way. But we call it the debt miracle. So another method is called the Smith Manoeuvre with dividends. Now, I know there's a fair number of people out there that when they do the Smith Manoeuvre, they invested in dividend stocks. Now, when you do that, what you're doing is you're actually creating a tax drag because you have to pay tax on that dividend all the time. And if you invested, let's say you invested and had much less from dividends, or you didn't try to get dividends, you just focus on growth because you always get some dividends, but when you're investing in companies, but you're basically investing for long-term growth, and most of your growth then could be deferred, and you only pay tax way down the road when you sell your investments. So if you invest tax efficiently, focusing on growth, you generally get these nice big tax refunds every year. If you're investing for dividends, you got this big dividend you have to pay tax on every year, so it's got this tax drag. And I've actually modeled it. I've run through some models, and generally you have to pay. You have to make about a 1% higher return, 1% per year for life, higher return with dividend stocks to be in the same position that you would be if you weren't doing dividend stocks. So there is that tax drag. Some people just feel more comfortable with dividend stocks. And that 1% tax drag is if it's Canadian dividends, where you're getting the lower tax on Canadian income. But it's, of course, it would be more than that if it was international. And usually, investing effectively, you want to invest globally, where most of the growth is outside of Canada, like in the US or Asia. So it's where you want to do most of your investing. And if you invest in dividend stocks out there, then they're even less tax efficient. So So Smith Manoeuvre with dividends, it is a strategy. Some people use it sometimes. You can also use it to pay your mortgage down more quickly. And when I modeled it with the 1%, where you need a 1% higher rate, I assumed that already. You take the dividends, pay it down on the mortgage, re-borrow to invest, so you're paying your mortgage off more quickly. However, because of the extra tax on the dividends, there's this big tax drag. So now, next method is called Smith-Snyder. Now, this one was actually about 10, 15 years ago. There was a bunch of mortgage brokers really out promoting this. And here's this, the thing is, this method actually has a real tax problem. All right, so, but however, this is something that you actually we actually very often do it with clients after they're retired. Okay, so the Smith-Snyder, the concept was that you would borrow to invest, put it in a mutual fund that has a large monthly payment coming to you. It's a fixed monthly payment that comes to you, and you use that to pay down the mortgage. The problem is the payment is so large, and it's fixed because it's not just taxable. Some of it is return of capital, some is your own money. Like, let's say it's paying 8% per year that's coming to you. Well, dividends aren't that high, and even the taxable distributions, whatever within it, aren't that much. And some of them actually had as much as 12% that they were paying you, and then they would pay it down on the mortgage. The problem is most of that return of capital, and so you're actually just getting your own money back. And so what that's kind of like is if you borrow to invest and then just take the investment out and just spend it yourself, then part of your debt becomes non-deductible. And that's what happens with Smith-Snyder, becomes non-deductible. So now, where the Smith-Snyder is useful is after you retire, because let's say now you've been saving up and you've got the nest egg. Now you're able to retire, you're financially independent, and you've got a large credit line, or you possibly convert it to a mortgage. It's all tax deductible, part of the Smith Maneuver, and you're retiring. So, and now you've got all this large investment portfolio. Part of it's Smith Manoeuvre and part of your RSP and TFSA. But now you want to start taking your retirement cash flow. And when you take that money out, depending on how much you take out, if you take out, if the cash you're taking out is more than the interest deductibility, what happens is some of your debt becomes non-deductible. So for a bunch of our retired clients, we're actually tracking this. You're taking money out, and their debt slowly becomes a bit non-deductible, but usually it's not that much. It's still 80, 90, 95% deductible for quite a few years, but it's part of the process of doing the retirement income when you do the Smith Maneuver. So that's Smith-Snyder. The last one's called the Rempel maximum. Okay, this is one I designed myself, and basically what it is, because I'm a math guy, we're just trying to figure out what's the maximum benefit you can get from the Smith Maneuver. So the idea here is you don't have you don't have a monthly amount being invested. Any monthly amount that you would have, you go out and borrow a higher amount so that it's your monthly amount is just paying interest. So for example, let's say that you were just paying your mortgage and you're paying $2,000 a month of principal in your mortgage, so you can borrow $2,000 a month and invest it. Okay, but $2,000 a month would cover about $500,000 of debt. So if you have $500,000 available in your credit line, or you can go and get an investment loan, $500,000. Okay, and now what happens is, so instead of just starting with zero and putting $2,000 a month in, you're putting $500,000 in. Your interest payment is $200,000 or $2,000 a month, and you're borrowing every month to pay the interest. Okay, again, it's this one and the triple top up are significantly more aggressive, more risky, and more methods than the other ones, but they're also ones can help you build wealth a lot faster. You have to be very careful with these to make sure that you could always maintain them, even with interest rates rising and all that. So it's something you have to do very carefully. But these can be the strategies, if you do them, over 20 or 30 years, they can have by far the biggest benefit for you. All right, so the last point to optimize Smith Maneuver is have the right mindset to avoid the risks. Okay, so now there are risks. Of course, you're borrowing to invest. It makes it a risky strategy. So the best way to deal with it, the main thing is to do it for a long term. And we always suggest that you commit for at least 20 years, doing it for at least 20 years. And the reason is because the stock market is reliable over the long term and not necessarily over the short term. So you need to be part of the Smith Manoeuvre success mindset is you need to be a long-term thinker. So, I've had people come to me and said, well, you know what, let me try Smith Manoeuvre for a year or two and see how it goes. I tell them, you know what, don't even start if that's your attitude, because, and I'll show you. So here's, if you're looking at a table here, then, so this is the, with S&P, the US, S&P 500, the US market, 150 years of data, 1 year. So if you do Smith Manoeuvre for 1 year, this is what your investment rate of return could be. 3 out of 4 are up, but there's quite a few cases where you're down after 1 year, right? So it's not really that useful. But see, if you commit to 25 years of Smith Manoeuvre, so here's what the stock market has done. So in this chart, every line is the rate of return over the last 25 years. Okay, and you'll see how reliable the stock market is long-term. And that's why if you do Smith Manoeuvre, I always recommend commit to a minimum of 20 or 30 years, and you're going to stick with it that long no matter what. And that is really the mindset you need to be successful with Smith Manoeuvre. So you have to be able to stay invested through the different down markets. So, I've had clients say, well, you know what? Well, I can market time and avoid declines. I tell them, you know what? If that's what you're thinking, I also recommend don't do Smith Manoeuvre, because if you can't tolerate a decline, like things might happen, things might go badly. However good of an investor you are, it'll probably go down some of the time. And you need to be able to stay with it. If you can't tolerate it, the decline, and you're going to try to market time to avoid it, but then you mess it up and you're down, you can never panic and sell at the bottom. You got to be able to stay with it. So, so you need the confidence to be able to stick with it. And a big thing is when it's down, when it's down, it's a good time. It's always a good buying opportunity. So, I'm no good. You can't predict the stock market. Nobody ever knows. Like, people always ask me, do you know where the market's, what's the market going, where is it going from here? And there is no point in history where I know where the market's going to be a week or a month or a year from now. And I don't believe anybody else who has, lots of people have opinions, but nobody can actually know that. All right. So the one prediction, though, when I make stock market predictions, though, I've been right 100% of the time. And the reason is I just know what kind of predictions you can make. So I predict that over the next 25 years, it'll be way higher. In fact, based on history, the market's always been between 7 and 17 times higher 25 years later. So so usually I predict it's just going to be way higher in 25 years. My other good prediction is when the market is down, and I usually use 20% as a definition. So whenever the market's down more than 20%, it's going to recover. And of course, based on history, stock market has recovered from every decline in the past. So not much of a prediction, but it's going to decline. And that's actually a really important part of Smith Manoeuvre, because when the investments are down, you should never think of it as, oh, should I panic and sell? What you should think about, is there a way to take advantage of this? Can I put more money in? And we had a client back in 2009 came to us trying to plan for retirement, wanted to do the Smith Manoeuvre, and we looked at the whole strategy. And the method for this client was actually included a significant investment loan. $300,000 investment loan. And so it was kind of a big number, and the market had just been going down. And he said, like, is this really a good time? Like, it's kind of scary right now. And all I told him is, look, at that point, the market was down about 40% from the peak. And all I could tell him is, you're down you're buying in about 40% lower than we were 6 months ago. So I can't tell you from here if it's going down further or what it's going to do. Okay, but all I know, you're getting in you're getting a 40% off sale, and I do know it's eventually going to recover that amount. So you're getting in at a good time. So he went out and did the loan, and by just luck, it turns out he did it 1 day before the bottom of the market, March 9th, 2009. The bottom was March 10th. And in went this big loan, and of course it recovered. And so he thinks I'm a genius because we put all this money and it's gone way up. But really, all it is, it's just having the confidence to know when the market is down, you have to always be confident the market's going up long term. And if you've got that confidence, then you can buy in when the market is down. So, and just to be able to show you that it really is reliable long term, this is the stock market over the last 200 years. 220 years actually. And notice that the trend line on the stock market, notice how the trend line, it's basically always going up over the long term, and the market is really never that far from the trend line. Now, you don't experience it like that because this is days, this is, decades that you're ahead or behind. So it's an exponential graph. But what this does show you is it is reliable through all the wacky stuff that has happened in the last 200 years. The market has always recovered. All the things that have happened in the last 200 years are way worse than anything going on now. Because I have people now coming to me saying, "What a horrible time! We got COVID, and we have recession and high interest rates and the war in Ukraine. What a horrible time." So you know what? This is actually a pretty minor time. Like, let's go back to last century. We had 2 world wars. There were 3 or 4 major pandemics around 1910, 1920, and at that time we didn't even have vaccines for them. So, and we had the Great Depression. We've had the really super high rates in the 70s and 80s where rates were 20%. So we've had way worse times in the last century than now. And through all of that, the market plowed through and did pretty well. So it's not really that bad of a time now. So great way to stick through it. Part of what helps you stick through it is to have it be as part of your financial plan, because if you said, look, I want to retire, this is how I want to retire, I've defined my goal and I know what I want to do, and this Smith Manoeuvre is an important piece of it that really helps you stick with it long term. So, all right, and so part of the mindset is you need to get into this concept of always having debt, because it's the traditional way of thinking is I'm paying debt. Eventually, it's gonna be paid off. I'm gonna be retired with no debt at all. What happens with Smith Manoeuvre is you convert your debt from non-deductible to deductible, but then generally the most effective thing is keep it forever. Now you could still sell investments and pay it off when you retire, but you're missing, another 30 years of great growth in tax-deductible interest. So the most effective thing is you just keep your tax-deductible credit line or forever, and until one day you're 85 and move to a retirement home, or maybe you pass away, maybe you die in your home and whatever it is. But the debt is paid off whenever the home is sold. It's not paid off by selling investments, and it's that concept of I always have debt. But that you have to get used to. But what that allows you to do, that means that all these investments are there to provide you with taxable income, or not taxable, with income and cash flow for your retirement. So all the investments are there just to provide you with cash flow. They don't have to pay off the debt because the house will eventually do that. But it's that it's that mindset of getting used to always having debt. But part of it is, so you focus then on the investments that you have. I get this huge portfolio that's giving me my financial security and retirement that I want. That's what it is. So, and so this, I just want to show you, this is, there's a difference between, stocks actually become less and less risky over time. So again, over short periods of time, they're fairly risky, but when you get to 20 years or more, they're actually less risky than bonds, but they do decline a lot. So you get 20 and 30 and 40% declines every so often, but it rebounds from all of them. So the bull markets after that are much bigger and last much longer. So you just stay with it. See, this is the same bear markets, but it's always going up over time. So the important thing is you need to have a high risk tolerance to do any of these Smith Manoeuvre strategies, but risk tolerance is a learned skill. You can learn to do it. I can tell you, so when I used to first start flying planes, I was terrified. Every time there was a bit of turbulence, I was grabbing onto the armrests, and oh my God, I was panicking. What's going to happen? Are we going to crash? And it was really, I was initially really scared to fly. Now I've flown lots of times, and also you just look around and you see it's turbulence, but no one else seems scared. You kind of realize this is what part of flying is. You get a bit of turbulence. Of course, the worst thing you could do when there's turbulence in a plane is jump out. You should never do that. Same thing with Smith Manoeuvre. You borrow to invest. Your investments go through some turbulence, but you know what? It's just part of the strategy. And you know what? Overall, it's going to work. It's going to get you to your destination. It's the fastest, most effective way to get to the destination over time. But you got to stick with it, and you got to ride through these turbulent times. So learning to to tolerate the risk of flying, which it really isn't risky. It's safer than driving, but really getting used to that feeling is something similar to the risk of investing. So those are the 5 big ways to optimize the Smith Manoeuvre and really get the biggest benefit from it. All right, thanks a lot for listening. Now, if you like this video, then please like and share it with your friends. Also, if you subscribe to my blog and also subscribe to my YouTube channel, what that means is you'll get all my videos and articles sent directly to you. Thanks for listening.